So in this video, we're going to talk about the income tax. And really, this is going to be kind of the theoretical base for another video I'm going to do where I actually walk through a 1040 federal income tax form. So this is kind of to lay the groundwork for that video. Okay, so the more income tax you pay is actually a good problem because it means you're earning more. That's because the income tax is a progressive tax, meaning that there are different tax brackets that change based on how much you earn. And as you earn more, you actually end up paying more tax. So let's see kind of how that looks in numbers. So you can see here that there are three columns here. This is the tax rate, and this is the income tax bracket that you fall into. Okay, so and then this is how the tax is calculated. Okay, so let's do an example here. Let's say you make $15,000 a year. You look here and you see, where does this 15K fall? And you see here that it's in this 10% tax bracket. So that means you basically look at this. You say, the amount of tax I'm going to owe is 10% of this 15,000. So that means I'll pay tax of 1,500. Okay. So now let's do another example. Let's say I make 150,000. Okay. So now we look in the income tax bracket. So it's not in here. It's not in here because I'm making more than the max here. So it's gonna fall into this category here. Okay. So how do we calculate the tax? So we're gonna be paying 22%. So for the first 19,900, we're gonna pay 10% on that. And then for the next amount from 19,001 to 81,050, we're paying 12%. And then and so that's basically how we got this number. Just uh this is the amount of tax from these previous two buckets. And so now we're in the 22% tax bracket. So it's telling us, so we add this 9,328, which is basically 19900 times 0.10, which is here, and then it is 81,050 minus 19900. So just the difference, and that multiplied by 0.12. So if you did this math, it's going to equal 9328. So on this 150,000, the first 81,050 is going to be, this is the tax I'm paying on it. And the additional amount, which is what it's saying here. So we're going to go 150 minus 81,050 times 0.22. So as you can see here, as you earn more, you're paying a higher percentage of that marginal amount in tax. So you're going to have this amount, which is for the first 81,050, plus 22% of the additional amount up to 150. And so I'm not going to do the math, but that's kind of how this works. So, if you're earning, let's say 450,000, you're going to be in this category here. So you're going to pay all these previous amounts plus 35% of whatever is over. So, from 450 minus 418 times 35%. So as you can see, the more you earn, each incremental amount, you're paying a higher percentage of that as tax. And so when people say, what tax bracket are you in, they're referring to where does your income fall into of these max amounts. So clearly, when you're in this highest bracket, each additional amount that you earn over this amount is going to be taxed at a higher rate than the first $20,000, which is only paying 10%. So as your income goes up, you end up paying more tax as a percentage of your income, because of this progressive tax rate structure. Okay, so let's talk about what determines your income tax. So clearly your level of income. So there's a couple of parts to this. There's earned income, which is like what you earn from working a job. There's capital gains, which is like if you invest in stocks and the stock goes from $10 a share to $20 a share, um, then that extra $10 you earned is called capital gains. So you didn't actually earn that. It's an investment gain. So that's what capital gains is. Investment income. So that stock can also pay dividends. So not only does it go up in value from $10 to $20, maybe it pays you $2 a year in a dividend. So that $2 is investment income. And then there's pension income, annuities, which are a kind of investment product, cancellation of debt. So if someone lent you $100, or let's say $1,000, and basically said, okay, you don't have to pay me back. If they canceled that debt for you, you received that $1,000 and you don't have to pay it back. So now you have to count that as income. So that's what cancellation of debt is. Gambling. So if you earn money gambling, then you have to pay tax on whatever you made. Alimony. If you're divorced and you're receiving alimony from your ex partner, you have to pay tax on that. Business income, prizes and awards. So if you're on Jeopardy and you won $50,000, you're gonna pay tax on that. Also, your filer status. So there are certain tax advantages to being married or in a domestic partnership or a head of a household. So basically, we're going to see this kind of in numbers later, but um, a single person is going to end up paying for the same amount of income more tax. A married person, um, there's two different ways to file. So if you're filing jointly, meaning, and this is advantageous for a couple where one partner is basically doing most of the earning and the other is maybe responsible for childcare or something else, where basically you get a larger standard deduction for filing jointly, and we're going to see what that means when we actually look at the numbers. But basically, if you're married and filing jointly, and there's only one earner, or there's one earner that's the predominant earner, then there's usually a tax benefit to that. You end up paying less tax. Um, Head of household is kind of a similar thing. If you're taking care of children or if you're taking care of elderly people, you end up paying less amount of tax. Um, and qualifying widow or widower, it's kind of you get certain benefits for doing that. So deductions, exemptions, and credits. And so we're going to talk about that in a little more detail. But basically, these are ways that you can reduce your income tax liability, by basically saying, okay, I earned 100, or I earned $50,000, but I have these certain expenses that I paid during the year that are, as per tax law, able to be subtracted from that $50,000 so I don't have to pay tax on that. So that we're going to talk in more detail about exactly what these are, but these are ways to basically lower your tax liability and the state you live in. So different states have different income tax levels and even different deductions and exemptions and credits. So the state you live in is a determinant in how much income tax you're going to pay. Okay, so I just wanted to go into a little more detail about capital gains. So they're from the sale of appreciated assets. So I mentioned stocks, also real estate, collectibles. Like if you have a car collection and you buy a collector car for 50,000 and you sell it for 80,000, that $30,000 of gain, 80K minus 50K equals 30. So this is a capital gain, and you're going to pay tax on this amount. Um, Crypto is also, I believe they're going to be tracking this now and asking you to pay tax if you uh, basically bought crypto and it appreciated. So even the tax authorities are will come after places that they see people are making money. So there are different tax rates. So I mentioned that this 30K here, you're going to pay tax, but there's a level of nuance here because there's different rates. So there's short term and long term. Um, if you hold the asset for longer than 1 year, then you end up paying this long-term capital gains rate, which is a lot less than uh, the short term, which is basically just a regular income. So we saw in the previous slide those different brackets. Uh, so for example, if you held the asset for a year, you end up paying 15%. Let's just call it 15%. But if you held it for the short term, if you're a high income person, and let's say you're in the 30% tax bracket, you might end up, this 30K you can say is going to be in addition to your regular income, and you're going to end up paying 30% tax on the gain. So, it's pretty substantial, the difference between long and short term gain, especially if you're high income and you're in a high tax bracket. So the incentive is that they want you to hold assets for the long term. So having a lower long term rate is kind of an incentive to do that. Okay, so the federal and state treatment are not necessarily the same. So the long term versus short term is a federal tax thing. But in California, actually, you end up actually paying uh, the full tax on capital gains. So this is just important to note that the federal and state are not necessarily the same. So there's a real estate exemption. This is kind of good to know, just general knowledge. So let's say you buy a house for 500K. And this is the house you live in. So this is the kind of rub with this exemption. You have to have lived in this house for, I believe, 3 of the last 5 years before you sell it. Um, and if you do qualify, meaning it was like your main house, basically the place you lived, your primary residence. And let's say you sell it for 800,000. Okay, so that means you have a 300,000 capital gain. Okay, which is a lot. I mean, if you had to pay tax on that, you're looking at, even if it was long term, you're looking at a $40,000 tax hit. Oh, sorry. If it's long term, then it's 30. Yeah, I mean, it's going to be 30,000, 30 to $40,000. Um, so what this exemption gives you is, if you're single, 250K of this would be tax exempt, meaning from this 300, you would actually only pay capital gains on 50K. And if you were married, see, this is another advantage of being a married taxpayer. You would actually pay no tax on this because you would be exempt for 500K of capital gains on your primary residence. So this is a pretty big tax gift from the government, and it's an incentive basically to be a homeowner. And so, just to clarify here, I just want to make sure this is clear. The long term and short term, 1 year is the cutoff for this, from when something becomes short term to long term. And so, a lot of people that are day traders, for example, they're very surprised by the tax bill that they get, especially if they're making money, assuming that they're making money, because they're going to end up paying all short term capital gains. Okay, so let's talk about deductions and adjustments. So deductions and adjustments reduce your taxable income. So let's talk about what some of these are. Let's first start with some adjustments. So educator expenses. So if you're a teacher, there are certain expenses that you can basically reduce your tax liability if you um, paid for certain expenses as an educator. Health savings account. We're going to talk a little bit more in more detail about what this is. but it's basically a type of investment account that allows you to put money into it and put it into investments. And the rub though is that you can only use it for health care related expenses. But as since it's an adjustment, it's actually something you are putting into this investment account, and it's tax free because you're able to, uh, let's say you put $5,000 into it, uh, you're able to reduce your taxable income. Let's say you made 50K, you can subtract out 5K. So then you end up only paying tax on 45K instead of 50K. So it's a way of reducing your taxable income. Self-employment items like self-employment tax, SEP or qualified retirement account contributions. Uh, if you paid alimony, if you made IRA contributions, which we're going to talk about, this is another type of uh, tax advantage investment account similar to the health savings account, except you can use this money for retirement. But we're going to talk about the IRA in a little more detail. And then student loan interest. So if you paid interest on a student loan, the interest that you paid is an adjustment that you can basically reduce your taxable income by. IRA, I guess I just mentioned it up here, but we'll talk a little bit about what an IRA is. An individual retirement account is what it stands for. Okay, so now let's talk about deductions. So there's two basic options. There's a standard deduction or you can itemize. So what does that mean? Basically, there are certain expenses in your life that you can uh, reduce your taxable income by, and they're numerous and varied. And so some people, instead of having to, the government is basically saying, okay, instead of having to track all this little minutia in your life, we'll offer you the standard deduction, which is $12,550 in 2021, and it kind of gets adjusted uh, based on the tax law and cost of living and stuff. So basically, like for in this 50K example, 50K, let's say that was your total income. If you take the standard deduction, you subtract 12,550 and whatever that is, 37,450, I think. You can check my math. But basically, you'll end up only paying tax on this amount if you took the standard deduction. However, some people may have more than 12,550 in deductions if they were to list them all out. So some people choose to itemize deductions. So what are the most common reasons why people would itemize instead of taking the standard deduction? So a big one is state and local tax. So if you're a homeowner, this is pretty applicable. You can basically, some people especially in California, their property tax alone is way more than 12,550. So, you know, so if you're paying a lot in property tax and state tax, uh, you would itemize. However, during the Trump administration, they actually capped the state and local tax itemized deduction at 10,000. So most people in California will hit this, and they'll probably have other itemized deductions. So it will still be worth it for them to take to itemize. And also, just one thing. I believe this is for a single person. This standard deduction is going to change based on your filing status, as I mentioned. Um, so this is just for a single person. So I believe it's like more than double if you're married, um, which is the reason why it is advantageous to file a married filing jointly if you are a single earner couple, because basically for the same amount of income, you're going to get twice the standard deduction. So you end up paying, you'll have a less of a tax liability. Okay, so now let's go back to this other itemized deductions that are common. So primary home mortgage interest. So this is a kind of related. So if you have a large property tax bill, you're also likely going to have a lot of mortgage interest that you pay. Um, so the mortgage interest is also something that you can itemize as a deduction. So let's say you capped out at 10K on this, and let's say you pay 30,000 in mortgage interest per year. You're already at 40K for your itemized deduction. So you've already exceeded the standard deduction. So you're just between your primary home. A lot of California homeowners face this. You're already way better off itemizing, which is why people do it. Also, gifts and charitable giving. Um, these are deductions that you can take as if you're giving to a tax exempt nonprofit like a 501c3. So these are also itemized deductions, and people that give a lot to charity, they often have pretty large deductions for charitable giving. Medical and dental expenses, so just your out of pocket, not what's reimbursed through your insurance. So if you had a 100K medical bill, and insurance covered 90K of it, and you paid 10K, this 10K would be possibly to be itemized. Okay, so now let's talk about credits. A deduction is where it reduces your taxable income. So if you made 100K, and let's say you had uh, 30K in deductions and adjustments, okay, that means you have 70K in taxable income. And so this 30K, these are deductions and adjustments. Okay, so you're still going to pay tax on this 70K. And let's say, just for making the math simple, let's say you're paying 20% tax, okay? So that's 14,000. This is your tax liability. Okay, so what a credit is a dollar for dollar deduction in this 14K. So let's say you had the option of taking 10K in deductions or 10K in credits, okay? A deduction is just going to reduce your taxable income. So it goes, let's say we had an additional 10K in deductions here. And so we had 60K of income. And if we paid 20% on that, that's 12K. So basically, that 10K in deductions, moving our 70K of taxable income to 60, only saved us $2,000 in tax, right? Because we were paying 14, now we're paying 12. So that 10K, this 10K basically in deductions only led to 2K savings. Okay. What a credit is, however, is a direct dollar for dollar reduction to that. Okay. So we're basically taking a 10K, we subtract 10K here, and we pay 4,000 in tax. So the credits are far more valuable. Okay. The deduction is only as good as whatever your marginal tax rate is. So if we had 10K in deductions and we're in the 20% tax bracket, it's going to be 20% times this, and that's going to be our actual dollar amount savings in the taxes we owe. However, credit is a dollar for dollar savings in the amount that we pay, as I kind of illustrated here. You're taking the 14K and you're subtracting all 10K in credits. Okay, so credits are very valuable. Okay, so I just explained this. Credits are better than deductions since you are getting a $1 credit means you have to pay $1 less in tax, but a $1 deduction is just reducing your tax by the marginal tax rate. Okay, so we kind of illustrated this. Okay, so what are ways to get tax credits? Because clearly they're far more valuable than deductions. So the earned income tax credit, this is for moderate and low income workers, and so it is just calculated through a formula, and it is gonna basically be a direct kind of subsidy to low and moderate income workers. But you have to have earned income to get this credit, meaning you have to have had a job and earned income in order to get this particular tax credit. Child tax credit. So this is for paying for childcare for moderate and low income workers. Again, you may qualify for this based on your income, and again, it's just calculated by a formula by eligibility. There are a lot of energy efficiency related tax credits. So for home solar, electric vehicle, home energy improvements, uh, governments will offer tax credits to offset the cost of doing these upgrades. There's education related tax credits. There's a limit to this, but there is a amount that you can get for educational expenses that you incur that will just be a tax credit. And so the deduction and credit game is very deep, and there are you know much more complicated strategies and ways to get tax credits and deductions that uh, are possible. But I'm just not going to be covering all everything here. Um, Real estate. I'll just give you one example. For real estate, there's something known as bonus depreciation. So if you own certain property, you can basically, let's say you buy a piece of property for 500K, and usually owning real estate, you can take deductions over time to offset rental income. So let's say normally you can take, uh, let's say 10K per year as a deduction against, let's say you earn 20K in rental income. You can take a 10K deduction for depreciation. This is a whole game in itself, and only end up paying tax on 10K of rental income. But there's something known as bonus depreciation, where let's say in the previous year you had uh, you had a gain, a large gain of 200K. Let's just throw out some numbers here, and basically there's an option you can do to take much more depreciation on this 500K in the same year and use it to offset this capital gain. So you can maybe even take, let's say 250K of a bonus depreciation from having bought this property. And so you can basically totally reduce any tax you have to pay on this gain on some totally unrelated property and offset it with a depreciation, uh, bonus depreciation from another property that you bought, and end up paying no tax on this. It's a deferral because eventually you have to pay tax on this depreciation you took, but you can keep doing this over and over. You can repeat this. So whenever you sell this property later, you can just buy another property the same year and offset this plus whatever gain you had. So with real estate especially, there are a lot of tax advantaged ways you can basically avoid paying capital gains tax for a long time, and maybe even ever, because you can keep avoiding it, and then when you die you pass it on to your heirs, and the tax basis basically changes so that your heirs won't have to pay tax on the gain. So again, this is probably outside the scope of this kind of module and the lessons that we're trying to, or rather the message I'm trying to kind of convey here, because this is maybe more real estate specific stuff. But just want to give you an idea that there are ways to play the tax game to legally figure out ways to defer or avoid paying tax.